Just about to enrolled agent, owner of Rogue Tax Professionals. The other day I got a question about taking auto expenses on your tax return. Essentially, there's two ways of deducting vehicle expenses. Oftentimes, probably most businesses use their personal vehicle for business. And then the question is, well, how do I deduct my expenses? Well, there's two ways of doing that. The most common way is just simply taking the standard mileage rate, which is currently 54.5 cents per mile. And so what that means is you drive 5,000 miles and you get 54.5% times 5,000, which in most cases will exceed the amount of money that is actually contributed to the vehicle in terms of fuel, insurance, maintenance, and those kinds of things. So it's actually a really great tax deduction. In order to qualify for that, you need to have a mileage log. You need to be frequently logging beginning odometer readings and ending odometer readings. The IRS is somewhat specific about having a beginning odometer reading and then an ending odometer reading every day that you use the vehicle for business. I have represented people in audits, and often they will accept addresses with miles, but to be safe, you want a beginning and ending odometer reading. Now, most people, 90% of the people, don't keep track of their miles. I suggest at least using an app like Mileage Bug or something like that in order to have some sort of miles reference. But it doesn't mean you shouldn't take miles if you don't know exactly how many miles you have. You should take them on your tax return. But just understand that if you were to get audited, the IRS could dispute your mileage because you don't have substantiation. The only way to substantiate it is by having a log that has daily odometer readings. The other way is just taking standard, the actual expenses, which means you can purchase a vehicle, you put it into use, you take depreciation, insurance, fuel, repairs and maintenance, and you deduct what you actually spent. Now, if it's a personal vehicle that you're using for business, you still have to keep track of miles just like you did before. And then you have to prorate the personal versus the business deduction. So say you use your vehicle for business 50% of the time, well, you only get to take 50% of those actual expenses. And most times, it's just better to take the standard mileage rate. If you are in a business that has a lot of customization to vehicles or heavy vehicles, like you've got vans or utility trucks, those kinds of things, then actual expenses will probably would be better for you, because typically those vehicles are 100% business use. You can argue that they're 100% use. Maybe you drive them home, but they have your insignia on it. I would say that's 100% business use. If you're not going to the grocery store, taking long trips, it's 100% business. You could take advantage of that. And so 100% of your actual expenses can be deducted. But oftentimes mileage is a better deduction. Now, you have to take actual expenses if you have more than 5 vehicles. 5 or more vehicles, you take actual expenses. And at that point, you've lost track, and it's just easier to keep track of the actual expenses. The other way that businesses often will take vehicle deductions is through leasing. Now, if you're leasing a vehicle for personal purposes and you use it for business, then that makes to prorate out the lease makes no sense. If you are leasing vehicles because you have a fleet of vehicles, or you have a vehicle that is on 100% use and you want a nice one, but you only use it for business, then you can do that. But almost at least 90% of the time, 90% of my clients typically service companies, those kinds of things. They're leasing, or they are using their own vehicle for business purposes, and the standard mileage rate is the better way to take those vehicle deductions.